Hi, today we're going to talk about why and how we should invest. And just to be clear, I'm not giving you financial advice. I don't know your financial situation, and I'm not licensed to do that. This is just for educational purposes, and I'm going to let you know some of my experiences so that hopefully you can learn a little bit from what I've seen. So, the first reason is we want to beat inflation because it's a silent wealth killer. So, when you have money in the bank's probably paying you a tenth of a percent interest, and that's nowhere near the rate of inflation, which varies between 2 to 5%, even higher some years. Savings accounts just won't keep up with that, so you need an alternative way to beat that inflation. Investing helps your money grow over time. So for me, I invest in stocks and in the S&P 500, which is the 500 largest US companies. That's averaged about 10% return over time. Now, some years it's a lot less than that, some years it's a lot more, but over the long term, I think about 100 years, it's averaged about 10%. So that more than keeps up with inflation, plus it grows your money and protects that purchasing power so that when you take your money out to buy an item or you want to invest in a down payment on a house or a car or something like that, that money that you saved up is going to have more purchasing power. So it can be misleading if you have $1,000 in the bank and year after year your bank keeps showing a $1,000 balance. That $1,000 isn't worth what it was when you put it in there, right? So year two, it might only be worth 950 or so. Year three, it might drop another $50. So if it's losing 2 to 5% a year, that number's staying the same, but when you go out to spend it, you're not getting the same goods and services as you did before. So that's why you don't want to keep an excessive amount saved in a bank. It's good to have some saved up in a bank just for emergency situations, but that's not an investment. Another reason you want to invest is to achieve financial dreams like retirement. So you want to fund a comfortable future, avoid relying on Social Security. Social Security, the whole system is expected to have pay cuts and budget cuts here probably in the next 10 years. So by 2035, they're projecting potentially a 20 to 30% cut in benefits. We don't want to rely on Social Security. I hope that doesn't happen, but in either case, you want to have your own plan apart from the government's, right? So don't depend on Social Security. You want your own financial independence. You might want to make a big purchase like a down payment for a house or children's college, home renovations, and investing can help you grow your money over time to save up a larger sum than you could do on your own. And then just gaining financial independence instead of relying on a paycheck, right? So paycheck is necessary early on, and I think a lot of us work well into our years for a paycheck. But if I had started early on in my teens and 20s investing in the stock market, I could probably retire now or even have retired already. So I didn't know at the time. I didn't have this education, so I'm hoping to pass it on to you so that you can save yourself some years and have financial independence earlier in life. So compounding is a great mathematical anomaly, and basically it's earning interest on your interest, so or on your growth. So when you invest in the stock market, if it does grow 10% in a year, say you had that $1,000 and it grew 10% in the first year, you'd have $1,100 the next year, right? That's cool, but the second year you'd get 10% on the 1,100. So I'm not going to do any math here on camera, but you'll get 10% on the 1,100, and then the next year you'll get 10%. I think that's 1,210. You get 10% on the 1,210, and that'll just keep compounding. So just as a powerful example, Warren Buffett, he's in his 90s now, but he's a multi-billionaire, right? He's got basically his company has hundreds of billions, Berkshire Hathaway. He made 90% of his wealth in the second half of his life after he was in his 50s. So that's because of compound growth. So he invested early and it started growing, but when you look at the chart between how much you contribute and how much growth makes up of your total balance, it's already happening with me, and I haven't been investing that long. About 10 years now I've been investing, since my mid-30s, and my chart's already starting to show the spread between how much I actually put in and contribute and how much growth is worth. So now almost half of my balance has come from growth, and over time that just gets bigger and bigger. So if I had done that when I was in my teens or 20s, my growth would probably make up 80 to 90% of my balance now. So start early, and it's a great investment in your future. So compounding is just amazing, really. The banks use it all day long against you. So they use it compounding the interest on your credit cards, And when you take out a credit card and say you spend $1,000, the next month, depending on what you make for a payment, if you don't make that full payment, you might see your balance actually grew or maintain the same. And then whatever your new balance is, they earn interest on that. So the banks are using this. That's how they earn so much money, right? You can use it in your favor too. And then building long-term wealth. We're not after a get-rich-quick scheme here. We're looking at a wealth building strategy. So we're thinking long-term. We're not day trading. That's a topic for a different day. I wouldn't recommend it, especially for beginners. But we're investing, so we're looking for opportunities to invest in strong companies and strong industries that we have confidence are going to grow. There'll be pullbacks and downturns in the stock market, but over the long term, those S&P companies have grown. On average, it's returned 10%, like I said. So there's other ETFs, there's other groups of companies, such as tech companies, there's industrial companies, there's companies focused on growth, companies focused on dividends. There's a lot of different categories. There's groups of companies that are focused on AI, artificial intelligence, and depending on what you believe the next big growth sector is, or what you believe in for the long term is going to grow, that's where we put our money, right? So for me, I like an ETF called VUG. That's the ticker symbol, and it's Vanguard's growth fund. So they're all growth stocks. They have companies like Microsoft, Amazon, Google in there, and it's done really well. It's also a little bit more volatile just because they are growth companies, so they might have some weak quarters and then some strong quarters. So you got to be willing to stay the course. And then let's see here. So it's a lot more effective than having money in the bank, and it passively grows your assets while you continue to work and pursue your dreams and your career and everything else. This is in addition to that. This is working for you on the side. So it's really powerful in the fact that it doesn't take up any more of your time other than the time it takes to click a few buttons every once a month or so to invest it. You can just go about your business and it grows for you while you're doing other things. So on that topic of passive income, there's one form of passive income called dividends. And dividends are when you invest in companies that have good cash flow, or for whatever reason they decide to pay out to their stockholders. And they vary in percentage. A lot of the good, strong companies will pay 1% to 2% dividends per year. And then those are usually paid out quarterly, so you divide that into quarters. It's not a lot, but it pays back to shareholders. Plus, if you're investing in companies that pay a dividend and they grow, there's an ETF that I've also invested in the past, not currently in it right now, but VIG, so that's Vanguard's Dividend Growth Fund. And those are companies that have proven over 10 years to increase their dividends. And so they're growing, the market itself is growing, their share price is growing, but they're also paying out dividends to the shareholders, which is really nice because you're getting two forms of growth there: the passive income dividend and the share price growth. And then another form of passive income or investing that some people use is real estate income, rentals. So people will buy real estate and then they might renovate them, rent them out, or some people actually live in part of the house or apartment and then rent out the other parts. So that's an idea. I've never tried that before, but it's one form of investing. Real estate over time seems to do pretty well, but in the short term, it can have some big fluctuations. As we've seen, housing prices right now have just skyrocketed. So I think real estate investors probably did well. But at some point, those real estate investments might come back down during a market downturn. And then just like stocks, you got to wait and ride it out until it comes back up again. Due to inflation, most things end up going up in the long run if they're solid investments like real estate and big companies in the stock market. That's not to say all investments go up. You can get involved in some investments that are poor quality and lose everything. So be aware of that and don't take it lightly that investments are volatile, stock market's volatile. So interest is on your high yield savings accounts, for example. You can open a high yield savings account with a bank. That'll give you a significantly better interest rate than a standard savings account. And I don't know for sure how they earn that interest, but I think they invest it in treasuries. I think the bank invests a portion in treasuries and the treasuries earn them interest. And then they just skim 0.5% or so off the top and give you the difference. So high yield savings accounts, they can be good for keeping your cash available, but they're not going to earn you a large return. Maybe, I think right now they're averaging about 3.5%. So it's decent. It's maybe barely keeping up with inflation, but it's certainly not growing a whole lot. So it's just a temporary place to hold cash to be ready for an emergency or a big purchase that you expect to make and you don't want to put it in the stock market. If you're going to need that cash in the short term, stock market can fluctuate, right? So you don't want it held up and tied up there in the stock market. If you know you're going to be buying a house or a car, or if you have some medical bills coming up, or your kids are going to college, then you want to have some cash set aside that's not in the stock market. That way, when the time comes, it'll be ready to go, and you don't have to worry about selling during a downturn. So that's the last thing you want to do, is be forced to sell because you need cash. So let's see here. Next category, diversification and risk management. You don't want to put all your eggs in one basket. So earlier I was talking about how I've invested in VUG, VIG. Another one is VOO. So VOO is Vanguard's, basically the S&P 500 version of Vanguard. So that is one way to diversify, is you can buy multiple different types of ETFs. I think that's probably the least risky. I like ETFs. The VUG gives you growth companies. The VIG gives you dividend growth companies. VOO would give you some of the largest companies. Now, between those three, that might not be a perfect example because those three have some overlap, especially the growth and the S&P 500 categories. There's a lot of the same companies are in both those groups. So you might also look at healthcare ETFs and industrial ETFs like energy, utilities, things like that. And consumer staples is another one. So you don't want to put all your eggs in one basket, especially as in one company. That if you're looking to invest for the really long term, like retirement funds and things, you don't want to put all your money into one or two companies. If that company goes bankrupt, you lose your life savings, right? So ETFs, that's why I like them. They spread your risk out among dozens or hundreds of companies. And then, let's see, it reduces your overall portfolio risk. So that's one of the reasons why we go with ETFs. Now, not to say that it can be fun to invest in a single company. I've invested in a few small companies and actually done really well in a small amount of time. Over the course of a couple weeks, I've earned 50% return on a single company. But then the following week, if I'm lucky, I sell and get my profits, because in the following week it might go back down 50%. So that's the risk, is that when you're investing in single companies and you're just trading like that, that's really what I should call that. The example I gave is more like trading. You're just momentum trading. So you're looking for the upswings and the downswings and trying to time it. That's a little more advanced and it's a lot more risky. If you do see companies that you just think and you're confident they're going to grow over the long term, and you like their technology and you can see that that industry is a strong one, and you just feel really good about it over the 10, 20 year horizon, then sure, you could invest over the long term. Just always keep in mind that, again, that company might get bought out. They might get a lot of competition as other companies come in to fill the space, and you could lose your investment. So that's why I caution you against investing in single companies. But if you do, get to know the company really well and their finances, their cash flow and profitability and things. We can go into that in more detail in another video about how to analyze a company and see how they're doing and see if they're a good investment. And then the next reason is you get to own a piece of the economy. So basically, investing in stocks means you're investing in a small part of a company, and investing in ETFs means you're investing in a small part of many companies. You're benefiting from the economic growth and success of those companies, but you're also exposed to any downturns they might experience. And then you're participating in the innovation and progress of those companies. So your money, along with all the other investors' money, is actually being used to finance that company, right? So that company is using some of those investor funds to grow and invest on their own. Might be in new technologies, might be in expansions. So you're helping to grow the economy, and you're helping to grow those companies. So I guess that brings me to another little segue, is that make sure that you believe in what you're investing in. If your money's going into companies that you strongly are against, and you don't like what they're investing in, and you don't like how they run things, that's something to think about too, because you could be helping to promote a company that you really object to. So know what you're investing in. If you get involved in an ETF, a group of companies, go and look up what that ETF contains so that you're familiar with what companies are in it and what industries are represented. And then tax advantages is another reason why we invest. 401ks are employer-sponsored accounts. So your employer will set that up, and if they offer it, you can put some of your paycheck into there, and it'll grow tax-deferred. So tax-deferred would be you don't pay taxes up front, you'll pay them later when you cash out. And what I would, personally, from what I've seen, 401ks are good if your employer matches. And if they give you a 1%, 2%, 3% match, the best I've probably seen is a 4% match. That's free money. So I made the mistake of not understanding what the match was, and I'd say it was about 12 years ago. I worked at an employer who did a 4% match, I think it was, and I thought that meant they only put in 4% of what you put in. So I thought for every $100 they put in $4. I was like, that's a waste of time, right? I'll just go and save my own money. I don't need their $4. Turns out 4% match means they will match 100% of what you put in up to 4% of your salary. So I missed out on so much free money because I didn't understand that. So basically you put in $100, they put in $100. You put in $400, they put in $400. And they'll do that. They'll match you all the way up to whatever percentage the company agrees to match. And that's a traditional account. The 401k traditional is where you have tax deferred growth. And then you have Roth versions of accounts too. So Roth means you pay taxes now, and then when you withdraw or cash out later, they're tax free. That's the kind I really love. If your employer offers a Roth version of these accounts, even if there's a Roth 401ks also, and Roth IRAs. So the 401k is employee sponsored. The IRA is just an individual retirement account that you can set up on your own. So again, employer version is 401k, and traditional 401ks have taxes deferred. You don't pay the taxes up front. You pay them later on in retirement when you withdraw. And then IRAs are individual retirement accounts. It's something you set up personally with a brokerage firm, investment firm like Vanguard or Fidelity or one of those. And then there's the traditional IRA, which is, again, tax deferred. You don't pay tax up front. You pay it later when you withdraw. And then there's Roth IRA, which is you pay the tax up front, and then you don't pay tax when you withdraw later. And that's what I have everything in is a Roth IRA. I like that because I pay all the tax up front, and right now, since I am a father of 4 and we have a lot of deductions because I have a lot of dependents, a big family, I get a low tax rate right now. And so I like being taxed now and not later. Now, if I was a single guy and didn't have all those deductions and my tax rate was high right now, I might have a different opinion about that. I haven't done the math to figure that out, where the cutoff is and where the benefit, the risk to reward ratio there is. But that's what I choose to do. I'm all in a Roth IRA. They are capped, and this year the cap for contributions to a Roth IRA is, I believe, $7,500 this year in 2025. I mean, that's a good chunk anyways, and some people might even have difficulty maxing that out. But if you can max it out, the government caps it because they know it's a sweet deal, and anything that's in there doesn't get taxed right later. So if you have a Roth IRA, it's maxed out at $7,500. The government doesn't want to miss out on any of those sweet tax returns later. So now we'll get to how to invest. We've been talking about why, and here's the how. It's a lot easier than you might think at first. You start by determining your financial goals in a timeline. What do you want to save for? I think for a lot of people, retirement is an important goal. They want to make sure that they have something when they're older and they can't work anymore, when they don't have a paycheck, and if Social Security doesn't keep up with the cost of living. So retirement's a big goal. That's why I personally invest, is mostly for retirement. And then some people also invest just to grow their savings so that they're ready to buy a house in the future, maybe pay for college, or because they have kids and they want to make sure that when their kids grow up, they're going to have some savings. So I did that too. So I'm investing for myself for retirement. I also invest a little bit for speculative stuff. I don't put too much into that, but every now and then I identify a company that I see is exciting and I believe is going to grow, and I'll put a small percentage into them just to try to take advantage of that opportunity. And then for my kids, I invested their money into the stock market right up until about 2 to 3 years before they turn 18, because those last few years before they turn 18, if the stock market does something wild and takes a turn down, I don't want them to lose all that value. I want them to have that savings when they become an adult. So that's what I chose to do, and it worked really well. I could have just put away cash for them, but I would have had to have invested a lot more of my own personal cash to do that. So it already was a sacrifice to put away money for each of my 4 kids, but the stock market helped me in getting that growth so that less of it had to come from my pocket and more of it came from investments. So we just have a target for each one of our kids and a certain number that we try to hit, and each one actually has a different amount because of inflation. So we started our son off, who's our oldest, at one number, and then I just added inflation for each of his sisters according to their ages. When they reach 18, they get an adjusted amount for the cost of inflation. So that's how we did that. And then when you need the money makes a big difference. Short term, mid-term, long term. So that's called your investment horizon. And Your investment horizon is going to determine what you invest in and how much you might withhold and keep in cash, right? So if my investment horizon was, let's say, a year from now, I want to make sure my cash is available a year from now, I'd probably take most of it out of the stock market, to be honest, just because in a year, the chances that the market could do something wild is pretty high. And if I have, let's just for round numbers, say I have $100,000 and I know in the next year I want to put a down payment on a house. I used to be able to buy a house with $100,000. Now it's just a down payment. But anyways, I know I'm going to do that in the next year, just for this example. Then I wouldn't want that in the stock market, because stock market has taken 20, 30, even 40% dips at certain times in history, and my 100,000 could turn into 70, 60,000 in a bad stock market dip, a correction they call it. So I'm not going to put my money in there for a 1 year time horizon or investment horizon. I'll probably put that into short-term treasuries, or just to earn a few percent, or a high yield savings account just to earn a few percent while I wait to buy the house. Now, if I have a 5-year time horizon, most likely I would put that in the market. Again, this is not financial advice, because I don't know your situation or your risk tolerance or anything like that, and I'm not licensed to give you that kind of advice. But in my opinion, what I would do is, if I want my money to be available in 5 years, I would invest that in the stock market, and then I'd be watching as I got close to that time horizon. 3-4 years from now, I'd be looking at the stock market and trying to judge, does this thing look like it's going strong? How's the economy doing? How's the job market doing? Are we at risk of a downturn anytime soon, a recession? And if I feel like things are still going strong, I might leave it in there right up till maybe the 4th year, and then probably cash out into a high yield savings account. If the market's looking like it's getting close to a recession, job market's looking weak, things like that, I might pull out earlier just to preserve the cash. But I would make a judgment call based on how the market looks, how the economy looks, how my investments are doing. 10-year horizon, I would just ride it out. A 10-year horizon is so long that the stock market is going to do so many things. If you cash out too early with a 10-year investment horizon, you're going to miss out on so many years of growth. Now, again, that's not financial advice, because the stock market has had a few occasions where even a 10-year horizon lost money, like the dot-com bubble, 99, 2000. It took, I think it was 13 years for that to recover. So if you had been invested right there at the peak in 1999, I think it would have taken you until 2012 to recover your value. So that's a worst case example, I'd say. Probably the only ones that are that bad are the Black Friday 1929, dot-com bubble of 99, and maybe the 2008 great financial crisis, the mortgage-backed security crisis there. Those three come to mind as probably some of the worst, that maybe a 10-year time horizon still wouldn't have recovered. Your investment might not have recovered in 10 years. But otherwise, in those major situations, most times the stock market will grow over 10 years. And so that's why I would say if my time horizon is 10 years, would just be in stocks for the majority of that. Again, when you get to the last few years of your time horizon, I would be taking a close look, analyzing what the market's doing and what you expect it to do. And then I honestly would do a little bit of timing. That's personally what I would do, is I'd try to time cash out to just try to hit the peak, or at least near the peak somewhere. So, if we're looking at a 20 plus year time horizon, I think there's no question. I don't think there's ever been a time in history where the stock market didn't grow substantially over 20 years. So that would be referring to accounts like me right now. I still have over 20 years to my estimated retirement date. So I have issues being invested in the stock market long term. Sometimes I'll take some out just to have some cash ready to buy a dip. So I did that recently. I cashed, or I just transferred some to from treasuries, so that I'll have some cash available if the stock market dips. But over 20 years, it's almost, I can't say guaranteed, but it's almost guaranteed to grow over 20 years. It's had a century of growing history, and 20 years is a pretty long-term horizon. So your goals are going to dictate your investment choices and your decisions. You do need to assess your risk tolerance. So in all those examples I just gave, those are my personal risk tolerances. You need to decide how comfortable you are with risk, and you might not be okay with that risk. You might not want to invest in individual companies at all, because losing that investment could be devastating to you. So that's why I always use a small percent when I'm going into a speculative investment. I just do a few percent of my portfolio. That way, if it really does tank, I don't lose everything. I lose that 3%. So basically, you can think of it this way: whatever part of your investment you're willing to lose. Reality that could happen with speculative investments. So what's your risk tolerance? How comfortable are you with market fluctuations? Can you handle seeing your investments go down? So that is another reality of investing, is that you need to learn to ride the roller coaster of the market. Like Dave Ramsey says, get off the roller coaster while it's moving, right? So that's kind of the deal with the stock market, is you can ride it down and not lose any money. Like if the stock market goes down 30% and you're in it, and you look at your balance and you think, oh my gosh, I lost 30% of my money. No, you didn't lose any money. You lost stock value, right? As long as you're invested in something that's good quality, that has good history, good strength, and that comes back up, you can still gain money, okay? You don't want to get panicked and start selling when it's down 30%, because that's actually the opposite how you make money in the stock market, right? You're essentially saying you're only going to buy when it's high and you're going to sell when it's low, which is exact opposite of how you make money. So you want to buy, it's low ideally, but you want to buy it consistently and regularly. And then if you have to sell, or you want to sell and you want to cash out, you want to do that at peaks. You don't want to do that at drops of 30%. So you've got to know yourself well enough. Can you handle that kind of volatility? It's going to do it, right? It's pretty much guaranteed you're going to have big swings in the stock market of 20, 30%, even more in some cases, like major crashes. Just know that at that moment you sell, you've locked in your losses, and now you actually have lost money. You haven't lost money until you actually sell your stocks. You've just lost value, right? And the value of those stocks can still go back up as long as you don't sell. Now, I'll say that with a caveat. If you're not invested in good, strong companies, and you haven't invested in good rounded ETFs with lots of diversification and things like that, and you're in speculative investments or single companies, and you see that thing starting to turn around, you better know what you're invested in, because it is possible, okay? Up a little bit, and let's talk about a Blockbuster or a Sears or a Kmart or any of those kind of things, and you're invested in that, you should know your company, because if you had held on, that never came back, right? Blockbuster's gone, Sears is gone, Kmart's gone. If you had held on to that, you really would have lost your entire investment and all your money. That never came back because those companies didn't keep up with innovation. They didn't keep up with their competition, right? Netflix, Blockbuster, and Amazon and Walmart. I think it was more Walmart at the time, kind of Sears. And now Amazon, I think, is trying to kill Walmart. But Walmart's doing a pretty good job of putting up a fight there. So anyways, know who you're invested in and know what you're invested in. And sometimes it is time to jump ship, right? It's a company like I had some Blockbuster stock, and then in a day when it was starting to dip and I saw consistently month over month they were just closing stores, that could be a good sign to get out, right? They're not growing, they're shrinking month after month, year after year. You might want to cash out before you lose everything. But that's for speculative investments, and you're just starting out, you don't want to get into that stuff. It's way too risky for a beginner, and there's even experienced traders who have lost life savings doing this kind of stuff. So you want to be invested in good, long-term, steady stocks that have a great history of growing and good cash position, and they're in industries that they're got a good part of the market share. So there's aggressive returns, there's moderate returns, conservative returns, depending on what you're after. So I think we'd all agree we'd like aggressive returns, right? We'd like 10%, 12% or more on our investment. Well, that sounds all nice, but with that comes 10%, 12% dips and corrections and fluctuations. So if you're looking to go after aggressive returns, you better be prepared for aggressive corrections as well, i.e. Price goes down. And moderate, you can have somewhere in the middle, maybe 5 to 6% returns on average over time, but also you're going to have corrections. The corrections probably just won't be as big as with the aggressive stocks. And then conservative would be things like bonds are one of the most conservative investments that people have used over the years. That's just because it's buying U.S. Treasuries or other types of bonds. Let's talk about U.S. Treasuries for a second. So the U.S. government will essentially borrow money from you using bonds. You can lend them money by buying U.S. Treasuries, and depending on what the length of the Treasury is, you can earn different interest rates. So one thing I'm doing right now is I invested some of my portfolio into SGOV. It's SGOV is the ticker symbol. And again, I'm not suggesting you buy that, but it's what I'm doing right now. And I did that because it's U.S. Treasuries and it returns about 3.5%. And I feel like at the moment the stock market is kind of on the cliff, right? So what I wanted to do was get my money into somewhere where I could earn a little bit of growth, but also be ready for a big stock market correction. And that way, when the market does correct, which over time I think it has to, just because it's so far up in space with its valuations right now, I'll take some of that cash that I side in SGov and go ahead and buy stocks with it again, because I still believe stocks are the way to go long term, but U.S. Treasuries are kind of to park your cash, historically safer. And then choosing an investment account, I use Vanguard for most of my stuff, and I know Fidelity is really popular. Les Schwab is another one. There's a number of different companies out there who can offer accounts. You can open them yourself if you're doing an IRA, or your employer might have one for you if it's a 401k. Let's see, we've got taxable brokerage accounts. Oh yeah, besides accounts, which is the 401k and the IRA, you've got regular brokerage accounts. So you can just open a brokerage account to do some stock trading. That's for other purpose, just because you want to, and it doesn't have to be associated with retirement or anything like that. You're not going to get any restrictions as far as maximums that you can invest in it, but you are going to get taxed. So if you earn growth in the account, you'll get to the end of the year just like it was income. There's a lot of tricks for the investors use to avoid paying taxes, but at the end of the day, earnings in that is going to be capital gains. I believe it's categorized as capital gains, and you'll pay taxes on it if it's just a regular brokerage account. But again, it can still be a good passive way to grow income. And then we've got understanding investment types. So we covered stocks, that's investment in a company. You're owning part of a company. We've got bonds, where you're lending money to a company or a government. So we didn't really get into talking about corporate bonds. We talked about government bonds or treasuries. But again, bonds are just it's money to either a company or the government, and they're paying you interest on your money. And then mutual funds. To tell you the truth, I don't know the difference in mutual funds and ETFs, other than I like ETFs because I can trade them all day long, from market open to market close. Mutual funds, you can only trade, as far as I understand it, you can only trade them once a day or at the end of the day when the market's closed or something. Anyways, they're similar to ETFs in the sense that they're groups of companies. They're professionally managed portfolios of stocks, bonds, or other assets, right? So I haven't used them just because I like the flexibility of ETFs. I like how I can trade in, trade out, sell when I want to. I can time my trades if I market doing funny things. Mutual funds are not like that, so they're not intended to be traded throughout the day, but they're similar. They're groups and baskets of funds like ETFs are. And then ETFs, obviously, like we've talked a lot here, they're a way to invest in a group of companies. But again, even though they're typically thought of as being safer than individual companies, they're not always safer, right? If they contain a group of risky companies, then the ETF itself is going to be risky. So you need to know what's in your ETFs. Make sure you analyze the contents of your ETF and know what companies are inside of it before you just you don't blindly invest in it. And then real estate, we talked about a little bit earlier, buying some real estate just for its appreciation of its value, so how it goes up in price over time typically, or as an actual active investment like renting it out. So you could either buy land with the intent to sell later at a higher value. You could a piece of property and strategically to business later, or you could possibly commercial piece and rent it out. Those tend to be, I think, lower maintenance commercial real estate, because businesses just tend to be less volatile than individual people and families, right? So you can buy a building and rent it out for like 5 or 10 years at a time under contracts, which from what I've heard is a little bit less maintenance, a lot less maintenance actually, than trying to buy apartments and duplexes and things and rent those out, because of the fact that you never know what kind of tenants you're going to get and how they're going to keep up your property, where business owners are usually, they have a lot more to lose, so they're usually a lot more considerate with property, and that they're less likely to do damage to your property and things like that. And then another tip here is to start small, be consistent. Don't feel like you have to put all in one lump sum. Even if you're looking to max out you don't need to do all $7,500 in January at the start of the year. You could do $600, $700 a month all year long, and then you have it maxed out by the end of the year. You might just starting small with, say $100. Just do it consistently, because it's going to be a lot less overwhelming. You're a lot more likely to be successful at this if you small and consistent, and then later if your income increases or you're able to reduce your expenses, you can always increase the amount, right? So Small and consistent contributions makes a difference. There are apps out there. The ones I've heard of are, well, I can only think of one at the moment. Acorns, I think, is the name of it. But there's a few apps out there that they'll collect like the different transactions that you do, and they'll put that change as an investment contribution. Of course, they're making money too because they're taking part of the earnings, that extra change, and they're investing it. So smart companies, big corporations are doing this all day long, and you should be doing it too, right? You should be investing your money. That's how they grow it. And if you're ever wondering, like, why do they offer, say, like Starbucks, every night I'll get a breakfast sandwich at Starbucks, and in order to use their app and get rewards, you have to put money on your Starbucks account. Why would they do that? That's not for your convenience. That's because you and millions of other people who put money on that app actually grow their balance sheet, right? So even though it's your money, they're essentially borrowing it for free. So when they do with a million other customers and you each have $10 in your account, they've got $10 million they can just invest and earn interest on all month long while your money sits there. I mean, because most of them aren't using up every dollar that's in our account, right? So all the dollars that just sit there that we're not using, that extra $5, $10, $15 that might be sitting on your account balance, combined with millions of other account balances, gives them millions of dollars they can invest and earn interest on. So think about that. Big corporations know this stuff and they use it to their advantage, and that's why it's something that we use it to our advantage too. We can make the same smart moves, and it doesn't need to be just the big corporations who benefit from it. Dollar cost averaging is a term you might hear. It just means putting in small investments on a consistent basis. It just means, you put it in the market's down and you put it in on a month when the market's up, and over time it averages out. It smooths out the fluctuations. Now, personally, I would prefer a method that I would call active dollar cost averaging, which would be when the market's down, put more in. Honestly, that's what I do. And then when the market's up, you might put less in, or you might just put your standard amount in. But that way you're making your those fluctuations. And then automate your investments. So personally, I like having control over when I make contributions, and I manually transfer that money each month. But you can set up your accounts. If you have trouble, keeping track of it, or it just makes it easier for you, you can automate it to do automatic withdrawals from your bank account to your investment account. Might be a good idea. Apps can help with that also. There's a few different apps out there. You could look them up on your app, and they'll help you automate transfers. And then educating yourself continuously is an important part of this. So there's a chance that the information I give today could become slightly outdated, change, and rates change, and the market changes. So even though I'm trying to make this advice or this teaching as timeless as possible, I can't control the fact that in the future the government's going to change policies, companies are going to go out of business, stocks that are good investments today could become bad, rates that are low today become high. So you need to be educating yourself continuously on this stuff, and follow articles, educational videos like this one, understand the basics and the foundations of this before investing or making major decisions. And the more you know, the more. So just to give you an idea how long it took me to learn about investing, I think I started about 10 years ago, and I'd say in the first year I just learned a ton, but I didn't have that long-term experience that comes with just years of investing. So I started 4% match from my employer, and that was about as far as I went. And then 3-4 years into it, I got a pretty good feel. But I had experimented day trading, and I found that I got super excited when I'd just make $1,000 in like 15 minutes day trading. And then I lost my first $1,000 the next 15 minutes day trading, and I did that a few times, and it was exciting, but it was palms were sweaty. I was checking my phone all day long, and it was distracting from everything else because I was so worried about what my day trades were doing. So after a few months of trying that on and off, I probably came around break even. I don't know if I gained or lost a little bit, but I just stopped that altogether. Day trading was not for me. And if you're not going to do it as a full-time job, there are some day traders out there that have way more advanced tools than you're probably going to get access to. So unless you're planning on doing that for a full-time job, I would stay away from day trading. It's pretty risky. But understand the foundations before you make any of these decisions, and don't take as your only education on this. Look for also, if you need to, go see a professional financial advisor and investing consultant and get some from them, because that's going to be dedicated to you. It's going to be personal to you and your situation, where this isn't anything you find online. Is just going to be sort of general education and not tailored to you and your situation. And then stay the course, avoid emotional decisions. like I said earlier, don't panic during market downturns, and don't get exuberant when markets are going up. Try to be stable and consistent as you can be. Long term, that's going to pay off. Short term, you might feel like you're missing out. And there's a term in investing called FOMO, F-O-M-O. It stands for fear of missing out. And don't be that guy who, you've market and you've seen it go through the roof, and all of a sudden you're excited and you're hearing from your friends that they're investing and they're earning and huge returns. The guy who jumps in after all that happens because you're afraid of missing out, because what you're essentially doing then is you're buying at the peak, right? Now it might still keep going up, but you want to be looking at this way before that time. You don't want to be waiting for it to hit exuberance and frenzy and peak levels before you invest. You want to be investing when it's boring, when everybody's stocks are markets down. That's when you want to be investing. And you want to be investing on the good months and the bad months, not just on the peak months, not just when all the frenzy's going on in the media. So be consistent. And then, like I mentioned, this is pretty complex, or it can be simple. It just depends on like how much you want into it. You can set and forget a lot if you just invest in some of the really solid long-term ETFs. You can somewhat forget it. You still do want to check in every once a year or so and see how things are going. But you set and forget if you've been investing in speculative and single companies. That could devastate you. So if you like that, you want to be watching those, studying those companies. Okay, but get some advice and help with this if you want to really get into it. You can do it yourself. I didn't pay any over the years to get this advice. I just kind of learned it over the course of 10 years. But make calculated risk decisions. Don't go, we're not at a casino here. Don't make it into a casino, because it certainly can be if you treat it that way. Make calculated decisions. Learn what you're doing. Watch more videos on this from other people as well. I'm going to continue making some more videos on specific areas of investing, and I hope you join me there in a future video. And I hope today that this information helps you, and it'll get you started on the path to investing. And just fight inflation. We're trying to grow our wealth, build a little bit of financial independence and security for the future. So if this was helpful to you, give me a thumbs up, give me a like. I'm trying to grow this channel, and I'm really hoping this could become like a full-time job day. So appreciate your support. I'll talk to you later.